Okay, let's dive right into this explainer. If you've had your eye on the real estate market lately, you know that buying your first home in Ontario is, well, it's one of the most exciting, yet literally, the most financially complex decisions you're ever going to make. We're going to lay out a structured, super easy to follow roadmap so you can navigate the 2026 Ontario market with absolute confidence.
Because, let's be honest, it is incredibly easy to get swept up in all the excitement, isn't it? But we also know that between the wildly fluctuating mortgage rates, the overwhelming financial jargon, and just the fast-changing landscape in regions like Kitchener-Waterloo, it can feel completely stressful. You're definitely not alone in feeling that pressure. But here's the good news. You really don't need to be a mortgage expert to get approved. You just need to understand the mechanics.
So I need to deliver a quick reality check before we go any further. Please, do not start by looking at listings. I know, it's so tempting to hit up open houses and start imagining exactly where your couch is going to go, but you absolutely have to understand the foundational mortgage math first. Otherwise, you risk falling head over heels for a property you simply can't safely afford, and that just leads to heartbreak.
To help lower that cognitive load and clear the fog, here's our roadmap for today. 1. The Ontario Mortgage Basics. 2. Surviving the stress test. 3. Funding your down payment. 4. The pre-approval process. 5. Passing the lender review. And finally, 6. Navigating the KW market.
All right, Part 1. The Ontario Mortgage Basics, Foundational Terms.
The two terms you absolutely must keep separate in your head are term and amortization. Your mortgage term is literally just the duration of your current contract, usually 1 to 5 years. The amortization, on the other hand, is the total time you plan to take to pay off the entire loan, which is often 25, or sometimes for first-time buyers in 2026, even 30 years. The absolutely crucial takeaway here is that the rate you accept today, it's not the rate you're going to pay forever. After your 5-year term ends, you've got to renew at whatever the market rates happen to be at that time.
And speaking of rates, let's look at the two main paths as of August 2026. On the fixed side, rates are sitting roughly between 3.94% and 4.8%. Now, these offer totally predictable payments, which is amazing for budgeting, but they do come with higher penalties if you end up having to break the contract early. Then on the variable side, rates are hovering around 3.35% to 3.50%. These fluctuate right along with the Bank of Canada's prime rate. So you get a bit less certainty, sure, but way more flexibility and much lower break penalties. Honestly, neither is automatically better. It really just comes entirely down to your personal risk tolerance and budget flexibility.
Let's move on to Part 2 and see how this builds. Surviving the stress test, proving affordability.
Here's the thing. Lenders do not evaluate you based on the rate you're actually offered. Under Canada's mortgage stress test, you have to prove you can afford your mortgage at a boldly higher threshold. That's either 5.25% or your contract rate plus a full 2%, basically whichever one is higher.
So what does that math actually look like in practice? Well, if your bank offers you a 5-year fixed contract rate of 4.04%, you are stress tested near 6.04%. Now, you won't actually pay 6.04% every month, but the lender uses that much higher number to calculate your maximum purchasing power. I know, it severely limits your budget, but it's really designed to make sure you could survive a scenario where borrowing costs unexpectedly spike down the road.
All right, Section 3. Funding your down payment, upfront cash needs. The minimum amount of cash you need up front depends entirely on the purchase price, and the math is tiered. For a home under $500,000, you just need 5%. If the home is between $500,000 and $1.49 million, you need 5% on that first $500K, and then 10% on the remainder. And anything at $1.5 million or above strictly requires a 20% down payment. Now, it's totally vital to note that if your down payment is less than 20%, you're going to trigger mandatory mortgage default insurance. You've probably heard it called CMHC insurance, and that gets added right onto your total mortgage balance.
Fortunately, Ontario buyers have some pretty strategic tools to build up that down payment. The First Home Savings Account, or FHSA, allows up to $40,000 in lifetime tax-free contributions and withdrawals. That's a huge help. The RRSP Home Buyers Plan also now lets you pull out up to $60,000. You can also use your own personal savings or even documented family gifts. But listen to me, here is a massive warning. You must have a clean 90-day paper trail. Any large, unexplained cash deposits that just suddenly appear in your account will completely stall the underwriting process. Lenders have to verify every single dollar, so right now is definitely not the time to deposit that stash of cash you've been keeping under the mattress.
Section 4. The pre-approval process, before House Hunter.
Okay,
It's time to completely reframe how we think about pre-approval. Do not think of it as a guaranteed ticket to buy a house. Think of it more as a conditional shield. It essentially locks in your interest rate for 90 to 120 days, which protects your buying power against any crazy market volatility while you're out there shopping.
But here is a huge reality check. Pre-approval is not final approval. A lender might absolutely love your financial profile, but they could still decline the specific house you want to buy if the home appraises for less than what you offered, if the property is in terrible shape, or even if a condo corporation has weak financial health. The lender can just say no. And this is exactly why dropping your financing condition just to win a bidding war is incredibly dangerous. If you do that and the lender declines the property, you could literally lose your entire deposit. No way you want that.
Moving right along to Section 5, Passing the Lender Review, the final application.
When it comes down to it, lenders assess you using a holistic 5-pillar scorecard. They verify your income stability. They look closely at your credit history. They review your debt ratios. They require a crystal clear source for your down payment. And finally, they analyze the quality of the property itself. The scary part, failing on just one of these pillars can completely jeopardize the entire deal.
Now, when we look at that credit pillar, a score of 680 is generally the absolute floor for getting the best pricing from A lenders. But 720 or higher is really your ideal target. And please remember this golden rule. Once you're pre-approved, strictly avoid taking on any new debt. Literally, do not finance a new car before closing. That new monthly payment will instantly alter your math and could easily ruin your final approval.
Lenders also cop your lifestyle using what are called debt service ratios. Your gross debt service, or GDS, measures your housing expenses against your income and maxes out around 39%. Your total debt service, or TDS, factors in your housing plus all your other debts, maxing out near 44%. And for those of you looking at condos, listen closely. 50% of your monthly condo fees are added directly to that GDS ratio that silently but very aggressively eats away at your total buying power.
Finally, Section 6, Navigating the KW Market, Local Market Reality, Summer 2026. When you actually look at the data from July 2026, you can see exactly what first-time buyers are up against. The average condo in Kitchener-Waterloo sits at roughly $353,000. Freehold townhouses are averaging around $550,000, while detached homes are way up near $760,000. When you apply those stress test limits and the down payment rules we just went over, the math heavily favors townhouses and condos over detached homes right now for the typical first-time buyer.
But wait, buying that $550,000 townhouse requires more than just your down payment. You have to face the closing costs reality. You need to budget an extra 1.5% to 4% of the purchase price for things like land transfer tax, legal fees, title insurance, and utility setups. I strongly urge you not to empty every last bank account just to scrape together the down payment. Think about it. If the furnace breaks on day one of homeownership, it shouldn't mean immediate financial ruin. You absolutely need an emergency buffer.
Which really brings us to the core thesis of this explainer. It's a quote from our sources that just perfectly contrasts the idealized max budget dream with practical reality. The best home purchase is not just one you can qualify for, it is one you can continue to enjoy without financial panic. Buying at the absolute maximum of your pre-approval leaves very little room for repairs, travel, childcare, or, simply enjoying life.
So before you log into that real estate portal tonight, I want to leave you with this thought. By understanding the math, gathering your paperwork, and actually respecting your true budget, you take total control of the process. So evaluate your true financial readiness. Will your first home be a well-planned stepping stone into your future, or a financial stumbling block? The choice, armed with this knowledge, is entirely yours. Thanks for joining me on this explainer, and happy house hunting.